The greatest enemy of knowledge is not ignorance, it is the illusion of knowledge. Hello and welcome back to Exploring Finance with Prashant. I am thrilled to have you here as we continue our exciting journey in the world of financial shenanigans. In previous episode, we discussed about revenue manipulations by companies. Let's talk about different one-time activities done by management to inflate the earnings. When a skilled chef wants to turn a simple dish into an extraordinary culinary experience, they might sprinkle a secret blend of spices or add a unique sauce. Not to be outdone, corporate executives have their own way of creating something seemingly impressive out of thin air when it comes to reporting earnings. Executives don't need exotic ingredients though, and they don't need to rely on mystique. All they need is a few simple techniques. In this episode, I am going to discuss with you in detail two types of techniques which are used by the management. The first one is using one-time events, and the second one is using misleading classifications to boost the revenue. Let's go on to the first segment, one-time events. First, let's talk about the dot-com hysteria. During the late 1990s, the rise of the dot-com technology startups grabbed the attention of investors, while established technology giants aimed to regain their former prominence. The addition of dot-com to a company's name led investors to pay more for its stock, regardless of the company's actual economic performance. Many investors were captivated by the potential for explosive growth in the new economy or the prospect of premium acquisitions. Some dot-com companies thrived, others merged with traditional businesses, and many went bankrupt. This focus on newcomers caused well-established tech companies like IBM, Intel, and Microsoft to be perceived as outdated. In 1999, IBM faced challenges with increasing costs outpacing revenue growth, leading to a lower gross margin. However, its operating and pre-tax profits remarkably surged by 30% despite the modest 7.2% growth in sales. This discrepancy should have raised concerns. A closer examination of the IBM's income statement revealed that its reported growth was due to a $4.1 billion gain from selling its global network business to AT&T. This gain was improperly included as a reduction in selling, general and administrative expenses, masking the company's actual performance. Excluding this one-time gain, IBM's performance in 1999 appeared much worse. Adjusted figures showed that the SG&A expenses increased by 12.7% and operating and pre-tax profits actually declined by 14.1 and 14.8% respectively. This example highlights the deceptive impact of such accounting maneuvers on financial reporting and the importance of careful analysis to uncover the true financial health of a company. Sometimes companies turn the sale of their business into a recurring revenue stream. They engage in transactions where they sell a business unit or asset to another company and simultaneously enter into agreements to repurchase the products or services from the sold business. Such deals, commonly seen in technology industry, can provide a one-time event, that is the business sale, combined with ongoing operational activities, that is the product sale, creating opportunities for financial manipulation. For instance, a mobile phone manufacturer might sell its battery manufacturing division but continue purchasing batteries from the buyer. This arrangement can lead to financial shenanigans. The seller might agree to a lower selling price in exchange for favorable terms on the future purchases. Or the buyer might pay less for the business but agree to overpay for the related products. An example is the November 2006 deal between Intel and Marvel. Intel sold assets to Marvel, and in return, Marvel committed to purchase a minimum quantity of semiconductor wafers from Intel at inflated prices. Marvel's financial reporting benefited from paying less for the business and more for the products, allowing it to manipulate its earnings over subsequent quarters. Such transactions involve complex negotiations where the total cash paid should align with the value derived from the business sale, and subsequent purchases. If one side overpay for the products, it likely underpaid for the business, and vice versa. These arrangements can create a recurring revenue stream for sellers, which is often preferred by investors over a one time business sale. We should always watch for the changes in the accounting policies that accelerate revenue recognition of income. Imagine a software company that provides subscription based services. Originally, they recognize subscription revenue upfront for the entire subscription period. To enhance the short term revenue, they might switch to recognizing revenue on a monthly basis, even though the actual service is being provided for a longer time. This change front loads revenue, making the current period's financials look impressive. Now let's move on to the second segment, boosting the income through misleading classifications. When evaluating a company's performance, it's crucial to examine its operating income, which stems from core business operation. Non-operating gains or losses unrelated to operations are important, but not for assessing the core performance. However, some companies may misclassify expenses or income to artificially boost the operating income, either by relocating unfavorable expenses or favorable income, often through questionable balance sheet decisions. Now, I'm going to give you some examples of this. Some companies shift the normal expenses below the line. Struggling companies often implement restructuring plan in which they incur one-time cost. These costs, like severance payments during office closures, are often separated from operating income and placed below the line. This practice, when done correctly, help investors understand recurring business performance. However, some companies misuse this by repeatedly recording such charges, potentially masking the normal expenses as one-time events. For example, Alcatel and Whirlpool have frequently recorded restructuring charges over many years, raising skepticism over their true nature and prompting SEC inquiries. Companies sometimes boost their operating profit by announcing plans to sell off the money losing divisions. For instance, a company with three divisions, Division A having an income of $100,000, Division B having an income of $250,000, and Division C having a loss of $400,000, can report a 50,000 net loss. However, designating Division C as discontinued makes it loss means that it will move the loss below the line, seemingly improving the operating income despite an overall loss. Sabre Corporation used this tactic before selling Travelocity, inflating the income from continued operation by treating Travelocity as discontinued, leading to misperception. Shifting non operating income above the line is more complex but still attempted. Inclusion of one time gain or non recurring income can distort a company's true financial state. Enron employed a strategic maneuver to boost the operating income by shifting the losses related to joint ventures off the balance sheet. In 1990s, Enron embarked on ventures that necessitated the significant capital investments and were expected to incur substantial losses initially. Fearing the impact on financial statements, Enron devised an unorthodox strategy using numerous partnerships to avoid consolidating debt and losses. By doing so, it aimed to keep debt off balance sheet and obscure the expected losses, leveraging a complicated structure to maintain gains or minimize the losses from early stage ventures. Interestingly, Enron used its own stock as capital in some joint ventures. As Enron's stock increased, so did the value of its equity stake in these partnerships, leading to reported earnings of around $85 million. This approach allowed Enron to capitalize its own rising stock value. However, when Enron's stock price fell, it concealed a resulting $90 million loss, claiming the results remained unconsolidated and thus excluding them from income statement. This dual approach allowed Enron to report gains while hiding the losses in the same investment vehicle. Ultimately, Enron's deceptive tactics contributed to its notorious downfall. Now let's wrap up today's episode and see what we have saw today. First, we saw that how investors get blinded by catchy labels, that is, the dot com bubble. Second, we saw that the businesses can transform a simple scale into a recurring revenue stream by selling a division and then buying back related products. Third, we discussed about how recurring and one-time expenses can be used to manipulate revenue, demanding a critical eye from investors. Remember, just as a captain navigates stormy seas with a keen eye on the compass, investors must navigate the financial world with caution and skepticism. Don't be swayed by catchy narratives or surface level numbers. By arming ourselves with the knowledge to recognize the financial manipulations, we are better equipped to make informed investment decisions. Thanks for listening to this podcast. In the next episode, we shall discuss how expenses are manipulated by companies for inflating revenue. Until then, keep questioning, keep learning, and keep exploring the captivating world of finance. Thank you. Have a nice day.